Welcome to the Dividend Talk podcast, episode 247. Earnings and Falling Knives. Hey, European DJ. How are you, buddy?
I'm doing really well. It's 12 degrees in Poland, friggin' cold, raining all day. It feels like Irish weather.
Look at that window behind me. What do you see?
Sun.
Sunshine, baby. It's been, I don't know, the last 2 weeks we're getting all the warm weather and it's meant to continue for 10 days. I mean, everybody's just so much happier when there's sunshine. It's great.
Well, it seems to be a great European exchange then, because we're still having probably more than a week of cold.
Yeah.
So I don't know where it's coming from, but it annoys me. It's end of May or mid-May. It should be like really sunny weather, nice weather for, sitting outside and
Now you know how we
really
feel.
fun.
Now you know how we feel and why we always complain. But it's so crazy. I was in Italy, Bologna there last week, and it was raining. Well, it was over here. The sun was splitting the rocks, as we like to say.
Wow.
But yeah, we like to enjoy it. Once we get it, we like to enjoy it because we know it will be gone pretty soon. So yeah, it's quite nice.
Oh boy.
It's quite nice. I'll stop gloating now. I'll stop gloating.
Yeah, but generally it has been a good week, right? I was also busy with work, but we've got so much to discuss today. I mean, I don't know if you followed social media, but yesterday you just couldn't escape the news about UnitedHealth Group. So definitely have to discuss about that one. But I think it's nice to start with a surprise from today, actually, because the CEO of Novo Nordisk is gone. Effectively, it was the foundation, I believe. They put some pressure on him.
Yeah.
And citing also the share price, which I find always very interesting, that sometimes corporate executives talk about the share price, as if it's down, that is bad, while not really thinking about the fundamentals.
Yeah.
And that's so interesting, right? So interesting.
It's scary in a way that they just focus on the share price and not really the underlying fundamentals. Is the company healthy? Are they in a good place? Will they continue to grow? And I suppose, look, there's a bit of competition from Eli Lilly, which they're not.
Well, a bit is a bit,
Yeah, I know.
It's
but
more than a bit.
But they must be a little bit scared of this. If there's competition in the market, the share price has dropped, and now the CEO drops. I mean,
the decisions of the CEO, one little decision can literally mean billions.
Yeah.
So you better have a very good CEO on top of it now, because you want to maximize this entire pie out of it here. So if there's like 10 billion to be earned, give the CEO $1 billion, because it's better than a sucker CEO at 100 million, only making 5 billion instead of 10 billion. So I would say give them very high bonus here if they are able to maximize all the billions, so that we as shareholders benefit, so they don't squander around. And
yeah. But the irony here is that he stepped down because of the share price, but as soon as that came out, the share price dropped a couple of percent, 3 or 4%. So
but it was not only the share price, of course, right? It was only nice to see that was also mentioned about the stock performance, which I find very ironic. Yeah, because usually you should not focus on that as a foundation or a board of directors. He's been in the business as a CEO, I think, with the company was 30 plus years, and then 8 years as a CEO.
Yeah, 8 years.
Yeah, so he has his whole hand in this GLP discovery, right? He scaled it effectively.
Yeah. I wonder if it was mutual, if he's getting out before something comes its way. But
we all know it, right? You need to know a person a bit closer. If you work for a CEO and you just see it's a sucker, sometimes you may have that you just know that this executive or the senior leader just doesn't have it. Then it also demotivates the rest of the leadership teams. So you need to really have a person that everyone believes in and really feel like, this guy is the right guy or this woman's the right woman. So it's very interesting, and let's see who comes next. But because I just said a little bit about which I believe in mainstream is very controversial. It's about CEO pay. How do you look at such things as CEO pay? Because I really look at it business case wise. If someone can earn 10 billion, mostly by their actions, by their ingenuity, that they should be paid handsomely for it. I don't think, for instance, giving someone 1 billion or half a billion is really making a difference in motivation. And I mean, usually a CEO with 10 million is already considered overpaid, right? In Western Europe. But just generally speaking, how do you look at CEO pay?
There's two ways of looking at it. You can look at it as an employee, and you look at what your CEO is earning, and you can be a little bit disgruntled because you're on the floor, you're working hard. I saw that in our own place when we got a new CEO a couple of years ago, and his salary came out and bonuses came out, and they're incremental, and there was a lot of people feeling hard done by. But I'm in the same boat as you. If they come in and they can turn the ship around, they make these decisions that will influence where we go as a business within the next 3, 4, 5 years. And that's fundamental to how much money the company makes. So why not? Why not? If the company's making money, why not reward them? I mean,
but then we would, of course, want to see long-term perspective, right? So would you pay them the bonus over this year out next year, or would you wait 5 to 10 years?
So
they often also play with options based on performance criteria and everything.
Yeah, I like it when it's incremental, that it's not all in one go. So you have a couple of years to bet in, and depending on this is what gets my back up, though. It depends on what metrics they're paid their bonuses on, because if it's based on earnings or something that they can financially engineer, they will for sure do that. But yeah, look, I've no problem rewarding them based on what they did last year. Similar to how I am. I work this year, I get a bonus next year. He should do the same. If he's performed, if the company's performed because of his decisions, then pay the person.
But you bring up a good point, because if it is too much, and it's hard to anchor around what's too much and what is right, it will demotivate employees. So also when you're like an executive committee, you also don't want to demotivate the whole workforce because there's one person that gets like 1,000 times more than the others, right? While we all know it's teamwork.
Yeah. It has to be proportionate, I think, across. I mean, if the workforce is paid above average for what they do, they should have no complaints. Complaints at all. Whereas if they're paid below average, but you have a CEO that's getting above average, the average times of what they're earning, then there may be a little bit of a problem. But
friction. And then you have, of course, in the banking sector, where they always say like, well, if we don't pay it, then we won't get a competent person. It's very, very difficult. That's why I like mostly founder-led and family-led businesses, because they have different motivations. Those are not career CEOs. Those are CEOs that really think about it for the long term. And then you have a few CEOs, but you only discover that once they're at the helm. After several years, you discover how they really are. Like Satya Nadella, he operates like a business owner. He doesn't operate as a quick career CEO, right? He really wants to bring Microsoft to a new place. You can see that in all his actions.
Yeah. But we can be quite harsh on CEOs as well. When a new CEO comes in, they're given maybe 12 months, 18 months, and then we judge them.
Yes, of course.
But, it can take a little bit longer if the culture of a place is not where you want it to be. It can take some time to shift the mindsets of employees that have been there to get them.
You need to see good communication. Like, was it Larry Culp from General Electric? I saw General Electric at the utmost bottom in the 10-year historical chart. But I held so long onto it because I thought this Larry Culp is a good CEO. The way he communicated, the way how he was also distancing himself from the old GE, his track record of Danaher, I knew he was a good CEO. And of course, I sell in the tax harvesting, and poof, they go up, right? Because all his actions 3-4 years later come into play at that moment in time. And I do think that many people have patience for a CEO, but the CEO need to really communicate transparently, Derek. I think that's very important. Like, and it's not just transparently, it's like kind of this, I say what I'm going to do, I do it, and I show what I've done and what the outcome was. This very clear communication, and there needs to be consistency in it. It's okay to change if you discover something new, but you can't change because you're just not understanding it anymore, because you expect people to be able to manage uncertainty, right?
Yeah. It's interesting. It's actually a very good discussion, isn't it, about CEOs? And my business, so where I work, has been two in the last couple of years, and we're probably going to go through another phase in the next couple of years. And it's interesting to see how the last CEO interacted with the new CEO and how that portrays across, because Europeans are different to Americans as well in terms of how they communicate and how, and he's very American.
Yeah.
And it's slower for us to uptake on that enthusiasm, that whole culture that they have. And he's trying to bring it in, and he's trying to get everyone on board. But it's a slow. I can see it's a slow process.
Yeah.
Particularly in our workforce. But yeah, I think we judge too fast. We judge them too fast. 12 months to 18 months is not a long time to change a culture of a place.
Yeah, but come on, you also know it with football. If you just have a manager or a coach, you just know when
of course,
slacker, right? So, and then it becomes a pain when you just know that you kind of they have a loser at the helm. Yeah.
Actually, I'm doing my deep dive on Accenture PLC.
Yeah.
And I was looking at their management, and I won't give too much away. I was looking at their management, and they've been pretty well managed for a couple of years. And then I looked to see who's on the board of directors. Who was the first name I saw?
I don't know.
Alan Yopi.
Oh no.
and I was after writing good management, and then I came back to this. I seen Alan Yopi, and I left a little footnote on it going, I need to come back to this.
Oh my God! But he's in the board of directors.
Yes.
I hope he's there for the tea with milk and a butter cookie. Yeah. Because much more he hasn't got to contribute, I'm afraid.
No. But it was quite funny. I thought you'd enjoy that.
And Bob Swan also in there.
Bob Swan.
That will make a party.
Imagine that. I might petition to get him on the board. Anyway,
then we both need to buy a share. We're going to fight for Bob Swan in there.
Anyway, while we're on this light-hearted discussion, before we get on to Falling Knives and UnitedHealthcare, let's talk about the Eurovision, because we're European and it's a big spectacle. Did you watch any of the semi-finals?
I watched the second semi-final a bit. The music was really bad.
That's not what we watch it for.
No, exactly. But did you see the show host yesterday with this? I don't know what she was wearing. This plastic,
they're like discs or something.
Yeah, discs or something. I mean, what was this? And then the boots. I mean, it's a freak show. It's really, but I love it.
Yeah, I do. It's my guilty pleasure. But I'm disappointed with the European community. They did not vote Ireland through. I'm disappointed with that.
But Ireland was. Usually, you have some good ballads.
Yeah, we went different this time. So we went for someone outside of Ireland. And we're trying to catch up with the whole Eurovision ethos, and we're a little bit behind. But hey, who's your favourites? Who do you think, or who do you want to win?
Yeah, Netherlands and Poland. Yeah, of course.
Yeah, I have been biased, right? Aside for them, who would you pick?
I find it hard to say at the moment. I haven't got a favorite yet.
I've got two songs that are just stuck in my head.
Yeah,
Estonia, Espresso Macchiato.
But this is this guy that with the funny dance and the mustache and the long hair.
Yeah, exactly. Yeah, I mean,
my kids love him. Love him.
It's brilliant. That one and San Marino, Tutti Italiana. So they're the two Italian teams, by the way. But
nice.
They're the two I want to win. The more I listen to Estonia's, the more I want
them to win.
I hope so. But I think there was some good ones. Sweden were good.
Yeah.
Poland was good. Spain is good. So,
but the whole act of Estonia is good, right?
Yeah.
I mean, the way he dance, my kids love it. They are also trying to dance already like that. I can't even. Yeah, it's right. I can't.
It's brilliant.
Yeah.
I mean, come on, they have to win.
Yeah. You will be watching live tomorrow?
No, I'm away tomorrow, so I'm going to record it. I will watch it Sunday night because we always watch as a family.
Same here.
We watch both semi-finals and we will wait. So I will have no notifications on. I'll watch that. Yeah. I'll watch that back on Sunday night.
And that's a sign that you don't need to be gay to watch the Eurovision. Yeah, if we watch it, then
so on Wednesday morning, I went in and at our work table, I asked, so did anyone watch the Eurovision? They were talking about football, they were talking about that, and they were all looking at me. I was like, you're all gay if you don't watch the Eurovision. And the whole place just laughed at me. Like, but it's I mean, it's guilty pleasure.
I watch every year with the whole family, the kids as well. And for me, it's nice, if you're a European dividend growth investor and you're passionate about European stocks, that there must be something in there that you like Europe as well. We can complain about European Commission, we can complain about tax and everything, but it's more the individual countries, right?
Yeah.
Because at least the European Commission is now, hopefully in 4 or 5 years from now, coming with the easier process for dividend tax reclaim, right? If you need to wait for the countries, it will never happen. So there's so much good in Europe that we appreciate.
Yeah. And what I like about the Eurovision is sometimes you get to see the actual culture of each country. Like sometimes that's forgotten because we're all nearly merging into one. But I mean, when you see the likes of Lithuania, Estonia, all these countries, and you see their personalities, their culture coming out,
But you also see some freaks, right? What are these cats? Well, which country is that? Or trees? They look like trees. All these ladies in tree clothes.
I can't remember who's that is, but yeah, they kind of bend over and all these tails come out.
Yeah. It's also weird. Pretty women, by the way.
Anyway, we get back to dividend stocks before we get carried away here. And look, we cannot not talk about United Healthcare. We got a couple of questions, as you would expect. Kieran Ainsley asked us, was there any red flags around United Health crashing? And Stephen asked us, what about the drop in UNH? Are they at buy levels now? So what's your take? What's your take on this?
Oof. Do you have a minute?
We have all day.
So maybe I'll answer the question first from Kieran, and then he can turn off the podcast if he doesn't want to listen further. But I wouldn't say that before the earnings call that there were red flags, because it was an interesting question. So I did look it up a little bit earlier when I saw that. I couldn't see red flags. So I think what really happened as such is that, I mean, I'll explain a little bit why no red flags. Yeah. I mean, it's a very profitable company, very profitable. Yeah. So they've been growing nicely over the years. The dividend has been following nicely over the years. It's been all the time very consistent. So from that point of view, it's hard to see a red flag. You could argue that the appointment of GF Kennedy is putting pressure on a business like them. So yes, there has been some share price pressure and everything. It was not anymore at all-time high, but this accounted for almost every pharma stock. Yeah. So in this case, if you think about, did I miss something? Did I make a mistake? I think that's very hard to say. At least I don't follow the stock neither close enough. I don't check their rubbish bins out of the office to see if there's something there out of pattern, right? So it's hard. But I think just the whole earnings report, there were just too many things at the same time that pushed the share price down. First of all, you need to know that a stock like United Healthcare Group was relatively rich priced. Yeah. So that's important. Yeah. I think it was like a 25 to 30 PE or something like that before the whole thing started tumbling down. So you could argue that that's a little bit priced for perfection. Yeah. And then I'm not talking now also about all the tariff impact. I'm really talking from where it was all-time high around $600. But yeah, what they're saying now is like rising healthcare costs are not helping with their Medicare. They expect that there's therefore more impact with this. It's called Medicare Advantage. Yeah, that is more impact, and which hits their profits. So they reduce their guidance. We checked, right? We did a bit of the revisiting of it. So and I think it's just important to call it out. So they were expecting, if I'm correct, they were expecting an outlook of $28.15 to $28.65. Let's say $28.50. They have now reduced it to $26.50. Yeah, which is about 10-12% decline.
Yeah.
So usually you would expect a company also to drop at least with 10-12%. But as it had already such a large multiple and it starts to kind of decline, a company gets harder hit. Yeah. Also, their earnings in 2024 went $27.66. So they're expecting to earn less this year than they did last year. So that just means that it kills the whole growth pattern that they had as a consistency over the years. And I think this is why it's hard so far, hit so hard. And then on top of that, the CEO is leaving.
Yep.
Never good news. Never good news. And then also, like a day later, we get the Wall Street Journal writing an article about, some potential fraud there with the with the Medicare reimbursement and such, right?
Overcharging or taking more money than they should.
Yes, or saying that people have something while maybe they didn't really have it, right?
Yeah.
So if you take this all together, it's like a poison cocktail. Yeah. For a share price. Yeah. It's crazy. And then I'm not surprised that the share price tanks by 30-40%. Sorry, it is like, I mean, you can't make this up. You can't. If we write a stock card, we didn't have one about UnitedHealth Group. I can't imagine that we would predict this to happen all at once for a company that has such a stability all the way until the first quarter of this year.
Yeah, I agree with you. If you were to look at the underlying numbers, you would think that it's in a pretty good place. It's in a very good place. You can see revenue, earnings, free cash flow growing at like low to mid digits year over year over the last 5 years. Low payout ratios, debt on the balance sheet is reasonable, plenty of cash flow. There's nothing there to suggest that this was going to happen. I mean, look, Trump came in and that pharmaceuticals are going to be under pressure. He's kind of hinted at that. So
yeah,
maybe you could see that bit coming, but that's only one piece of the pie. Yeah.
And that was already priced in before the earnings came in.
Yeah, that's only one piece of the pie. But I think it's a culmination, as you said, of Trump then having his executive order on May 12th, I think. Then you have the earnings, then you have the CEO stepping down, then you have this legal
news article.
So I mean, like it's as you said, a poison cocktail. But what do you think? Like, well, would you buy that? Would you buy the company? So we got a question from Tardius on this, and he said, at what price level, think about margin safety, would you consider this company a buy?
I think I would never buy it, and that's also what he says. Yeah, that he would probably never, because I simply really don't understand the moral pricing or the immoral pricing that they have, and why Americans accept this. Yeah, I don't understand their healthcare system. I think it's, maybe we're spoiled here a little bit in Europe, but I don't understand it. So for me, therefore, it's really, this is this kind of Peter Lynch thinking. You need to kind of buy what you like and what you would like to own. So if you like Nike shoes, that's usually a good sign that maybe buying Nike is good. So if you have that feeling already for it, then start doing the analysis of the business and the stock.
Yeah.
That's why I've never analyzed UnitedHealth Group actually until now, because now it's just because hitting the news and it's for us on the podcast.
Yeah.
But before that, it just doesn't attract me. Yeah. And then there are enough insurers in the world. So that's maybe the first answer to the question. But let's take that away. Let's assume that I understand the business and let's start looking at the stock.
Yes.
The dividend is $8.40 for this year on a predicted guidance of $26. We're talking here about a 30-something payout ratio. That's a really low payout ratio. It may mean that they can still have a 65% reduction in their guidance and the dividend will still be covered. Yeah. So from that point of view, tick in the box. Yep. Balance sheet rated A2 by the credit rating agency. Good sign, but we've seen in the great financial crisis, you can't trust it always. Yeah. So let's look ourselves also into this then. And I did, right? So if you take the current cash that they have on the balance sheet is 34 billion. The current debt that they have on the balance sheet is 71 billion. So you're talking here about a 37 billion net debt on a 95 billion equity to shareholders.
Yeah.
Yeah. So if you take it from that point of view, very optimistic, you're talking about a 30 to 40% debt to equity. Yeah. If you take net debt into consideration.
Yeah.
Their cash flow was last year about free cash flow, about 25 billion. Let's say on average over the last 4 years, around 22, 23 billion. So this 37 billion, if they would cancel all the dividends, they will be able to pay it back in 1.5 years under current circumstances. If they want to not repurchase any stocks, it would take them 2 years. If they would stop the buyback machine, within 2 years, they can cancel all debt. So under current circumstances, based on their current guidance, here. So when you look at these kinds of factors, Derek, it has very healthy financial statements. Yeah, very healthy. And then, if you look at the historical dividend yield, it is now for the first time above 3%. For the very first time. Yeah. And if you look at the whole pattern of history, right? And I'm looking here from January 2019 onwards, the only time when it touched the 2%, that was in October 2019, and it was during COVID. It was 2.2%. Now it's 3%. Yeah. So all I'm trying to say is like the dividend more than doubled because of the share price falling. 3%. I may not have seen it in the last decade even. Yeah, in the entire history. I can probably also quickly check that up, how it was in the last decade. So if I look at the last decade, then so 95% of the time, the yield was lower than 1.8% of the entire decade. And it was only twice really above touching the 2%. That was in 2019 and 2020. So if you take this all into consideration and you think that the Wall Street Journal, what is mentioning there by whistleblower, there was a very interesting tweet also on X from a guy, Say No to Trading, I think is his handle, who was saying like, look, whistleblowers have an incentive in the US because all the money that will be recouped out of that, they get a certain percentage of it. So there's a very interesting incentive as well to be a whistleblower, because if, for instance, they would be fined 10, 15 billion and you get 10% of that, that's a good incentive to speak up, right? And when I read the article, there's nothing concrete in there. Nothing. Yeah. So I don't like fraud, specifically not accounting fraud. This one, it is really a question, do you feel comfortable with that? Yeah. I wouldn't be surprised at all if United Healthcare is doing this kind of stuff, because it has the smell all over it, right? This company. But again, that's just speculation. But stock-wise, if you look purely at the fundamental stock-wise, it looks good. If you look at the business analysis, you're just dealing with a business that, in my opinion, is just a sin stock like tobacco and everything, and gambling stocks. For me, this healthcare company falls in the same category. So it definitely needs to yield 3% before it becomes attractive to me.
Yeah. I think with this whistleblower, I think there must be some merit to it, particularly as the CEO stepped down. There must be a link between that. So that, I mean, I would not be surprised.
But this is where we are missing transparency.
Exactly.
Yeah, because what they said, their response to the Wall Street Journal, how you said, article, it's just, you don't do that. So we have not been notified by the Department of Justice of the supposed criminal investigation reported without official attribution in the Wall Street Journal today. The Wall Street Journal's reporting is deeply irresponsible, as even it admits that the exact nature of the potential criminal allegations is unclear. We stand by the integrity of our Medicare Advantage program. For me, this is kind of, you go into the attack with your lawyers, thinking that this is your strongest defense. What I see here is like a bunch of bullies
Yeah.
For me, it makes me even more thinking like there's something going on there. But they need to be transparent. What does personal mean? Just tell them. Is it an illness? Is it afraid of being executed by the next idiot on the street? What is it?
Yeah.
We investors deserve this, because now you get speculation, which leads to weird things on the share price, which many shareholders are interested in. So transparency here is really bad, really bad.
Yeah, I agree 100%. And look, taking all those into consideration, I think what you're saying is, assuming you understand the business and you're comfortable in owning an insurance sin stock, fundamentally it looks in a good place.
Yeah. If you look at the typical fundamentals we look at from dividend safety point of view, not taking the business analysis into consideration, it looks very good.
Yeah. But I don't think I would ever buy this company. It's hard for us as Europeans, as you said. We're a little bit spoiled. And I think, in fairness to Trump, I think he's trying to
do the right thing,
bring in the European style model to America. And I don't know what effects that's going to have. Maybe it's going to drive the prices up for us over here. Who knows? But yeah, I just struggle to understand this type of company and how Americans put up with this kind of pricing. So it's crazy. It's crazy.
But a very interesting case to study, I must say. Really interesting, because this could be the buy of the decade for some people. Yeah, but it could also be this falling knife.
Yeah.
And maybe that's still a question that I have right to you. How do you deal with this kind? How imagine this was a holding in your company, let's say a top 5 holding.
Yeah.
How do you deal with these situations? Do you buy more?
So
let's change the name UnitedHealth Group. What is your number 1 position?
Maybe ASRNL.AS, someone like that.
Okay, let's take Ahold-Delhaize. Ahold-Delhaize CEO is leaving.
Yep.
Personal reasons.
Yep.
Yeah. There's a whistleblower saying that they have been doing a bit of price manipulation. Yeah. And then what else? What do we want to add in the mix? Oh yeah, they lowered their guidance.
Yeah, I'm not selling on guidance lowering or anything like that. It would concern me around the whistleblower side. But as you said, it's just speculation. I'm not straight away. I'm not selling now. Fundamentally, the company is sound. That's what I'm looking at. I'm looking at the numbers. What can they do? And even if there is some fraud here, we don't know what the impact of that will be yet, or what the nature of that is. So if I was to put this into a top company in my portfolio, I'm not selling. I'm not selling at the moment. I don't know if I'm buying more. So it's that whole, I don't like fraud either. And even the mere mention of it kind of puts you for pause until you know more. So I don't think I'll be buying more, but I'm definitely not rushing to sell at this moment.
And you know that Ahold has a history of fraud.
Of course,
in the early 2000s, the share price went rock bottom.
Yeah.
Great buying opportunity, by the way, at the bottom there. That's always the case. Yeah. So what I would say is, like, if here it comes really to, you can't borrow conviction. Yeah. And in the end, a price can go to zero. So it is now, what is it, $280? Nothing. It can go to zero. Yeah. So it really can. That can happen to every position in your portfolio. So first of all, this is why I've got rules that I don't want a position to be too big. So if that position was already at that size, and in these cases, I would argue to look at position size at cost of acquisition when you go into the minus. Don't start doubling down, because if it goes in half and you think like, oh, I'll double it because it's again in this position size. Well, if it goes in half again, you end up again doubling, and it can go in half exponentially. Yeah. It's probably called the inverted way of exponentially. Forgive me for my math. Yeah. So that I would always look at the acquisition cost sizing when stocks go down. And if you already had a full position, I wouldn't buy more. And secondly, I would not buy on the decline. I would let it play out at least a week or 2 weeks, because it went now to $270. It touched yesterday $250 even. It was at 500 or 600 not too long ago. imagine now that there comes news out of it that the DOJ is not doing, there's nothing criminal. The CEO went for personal reasons away because, I don't know, was suffering from Alzheimer, was not sustainable. They wanted to keep it in the private space. Da-di-da-di-da. Let's assume it kicks up on a single day back to $330.
Yeah.
If you look at what it's generating in cash flow, I wouldn't be surprised if $330 is still a really good price for the business then, if you have this conviction.
Yeah.
And then, okay, yeah, you missed out $60, you missed out 20%. So be it. You still will get it at a 2.5 to 2.8% yield, which is historically very good for such a company, because you really don't need to be a stock market hero.
Yeah. And what I find is, and we can take medical properties trust as an example.
Yeah.
What I find is that unless you had conviction before this drop, maybe they were on your watch list.
Yeah.
And you were studying this company, you're like, I want to buy them at such a price, and now they drop. Of course, it is a good buying opportunity, and you might want to take advantage of that. But if this was never on your watch list before, you were never looking at this company, and they're only on your radar now because the price has dropped, and you think that it could be the buy of a lifetime.
Yeah.
That is the wrong reason to buy the company.
Yeah.
You don't have conviction, you're following the share price. And I found with Medical Properties Trust, that's what we saw over and over.
And many people got burned there, really many people.
Exactly. So it all comes down to conviction and having your work done before something happens.
Yeah, and you can't do a whole business analysis in a single day. If the share price is dropping 20%, and you have never opened the annual report of this company, but some people on social media say like buy, yeah, and or you just see the share price and you think like, this is a stalwart, this is a great company.
Yeah.
How do you know it? You've not even opened an annual report. So everyone who's listening now that actually bought UnitedHealth Group and didn't open an annual report and can't say what business units they have, can't even properly say which one is growing or not, I'm sorry, you probably are indeed based on the price anchoring, buying, and going with the crowd.
If I was to do a deep dive on them right now, I would be biased on what's happening right now.
Yeah,
I could not be. So
yeah.
I don't think, like, if I was to do a deep dive and say, right, I have strong conviction, I'm actually probably biased because their yield is 3% for the first time ever, and it's definitely playing in the back of my mind.
Yeah.
So I think for events like this, if you have the work done beforehand and you're waiting for something to happen to give you that, like,
then it's buy.
Then buy. But if you don't,
wait for the weekend. Spend the weekend a little bit going through their materials, and if it's a shop, try to see if you know someone that's shopping there. Go through the reviews, these kinds of things. Familiarize yourself then with the business if you really want to take a serious look at it.
Yes, and invert. Find a reason not to buy them, and if you still come out thinking, okay, it's a no-brainer, then go nuts. But if you're
and at the same time, you get ASR for 5 or 6%.
Yeah, I know. Yeah. we stick to European insurers.
Yes, exactly. It's not a health insurer ASR, but
Nice. Let's talk some dividend hikes. I actually only have one dividend hike, but I thought you might like this one, and it is Chubb. It raised its dividend by 6.6%.
Yeah, liking is a big word, Derek. I don't know what the payout ratio now is, because this company used to hike. Like once in a while 20-25%. Yeah, because the dividend yield is it 1% something. Yeah, it's no fun anymore. Yeah, but I need a little bit more. The company is on fire, earnings wise. Yeah, but it just yield wise, it's really staying behind. Yeah, it has a 16% payout ratio on EPS and 9% on free cash flow. I expect more. Yeah, they can double the dividend quite easily.
Yeah, and I mean, I don't follow the company, but are they buying back shares? Are they doing?
Not a lot.
No.
And they used to do this. Yeah, they have now 30 years of growth, but they used to do these really quick bumps and sometimes even I believe a special dividend. But already for quite some time, they are just hiking it by a few percent. Yeah, their 5-year dividend CAGR is 3.4%, I believe.
Yeah.
So this is one on the higher end, but but they can easily check 25 to raise 25 to 50% at the moment. No problem at all. They're very, very, very conservative at the moment.
Yeah, and there must be a reason for that. Maybe they might need money for reinvestment, or they might see something else happening. But yeah, I'm just looking at
I'm not seeing it.
Yeah, looking at the buyback yield, it is quite low. They have plenty of cash. They could definitely do better than that. But hey, look, 6% is still a decent price.
I mean, I'll take it. Don't worry. But I was hoping, well, I finally get this 25-30% dividend hike that we deserve as shareholders. Yeah.
Nice. I don't know if there's any other dividend hikes that I've missed, but Chubb stuff.
Nothing worth mentioning, I believe.
Okay, we have a couple of earnings to get through, 2 of them, and I might start with Siemens. So Siemens did quite well, I would say, this month, or this quarter, should I say. They had a strong overall quarter. Their orders were up 10%, so that was 21.6 billion, and their revenue grew 7%. So it's quite strong numbers. And their industrial business profit jumped 29%, and their net income rose 11%. But a couple of things stuck out to me. So smart infrastructure was probably the star performer here. That was up 12% overall. So revenue was up 12%, and its profits were up 61% as they increased their margins up to 24%, which was quite good. There was some benefits there from a gain in the selling of an existing wiring business that I think I spoke about last time. Mobility was up 23%. Healthineers was up 14%. Now, the weak spot, again, is digital industries. Revenue is down 5%. So every other part of the business is growing, but digital industries is still down. So that's one to keep an eye on. But I think once you start to see a turnaround in that, we might start to see industries actually spending a little bit more money. So I think they're still conservative at the moment. Free cash flow was down 25%, but that was, from what I could see, due to higher tax payments and also a couple of acquisitions. So there was 2 acquisitions. One was Altair, which closed for about 9.5 billion. And there's another one called Dotmatics, which I think is meant to close early next year. But Altair, Altair, right? It's quite an interesting one, but I think we're going to start to see more of these type of acquisitions from Siemens. So it's in tethering towards the AI world. It's all this infrastructure, cloud, and AI. And I don't know much more about the business other than that, but they spent 9.5 billion on them, so they have a lot of hope for this type of company. And they also sold Siemens Energy and Healthineers, so they raised about 3.5, maybe 4 billion in cash from that as well. So yeah, look, overall it looked quite strong. I just having a quick look at the balance sheet, I can see pension liabilities is quite low. It's the lowest it's been in a long time. It's 0.8 billion. Net debt rose slightly, but debt to EBITDA is still at only 1.1. So yeah, I think overall it's been quite a strong quarter for them. They've remained with their guidance for the year as well. So yeah, look,
sounds like a broken record on Siemens, but they just continue to deliver. It's amazing.
They do. They're like the postman. They keep delivering. I don't know. I don't know what the share price is actually.
It's like, we often discuss them here in the earnings, right? And it's always the same conclusion, like clockwork almost. And therefore, an industrial, which is really not easy. They're really in a difficult business area. All these contracts, RFPs, everything, lots of dealing with the government, long investments, windmills, all these kinds of things. It's a tough business to be in.
Yeah, it is. But they're well spread out across a lot of different aspects of that. So they're quite well diversified. I just checked the share price and I wish I didn't. Because I remember on this show we were saying they were under 100 and we should have backed up the truck and we didn't. They're now €219. They're just never dropping. They just keep going up.
Oh, and up. Nice. Let me check. Where is it now in my portfolio? Okay. I've got 134% return on it, on share price alone. Yeah. My yield on cost is 5.5%. Not bad. By the way, I see now, because the first time I checked my portfolio this week, I am 0.15% down from all-time high. I did this because when all this stuff started to break out with Trump, I wanted to put an anchor in there for my portfolio, because what I sometimes notice when there's like a crash, then I don't see it in my charts, because really quickly we're out of it again. So I felt like, would this be like within a quarter already be resolved? So I'm probably next week, if the market goes up a bit, I will be hitting an all-time high again with my portfolio, which is very interesting. And I didn't buy a lot of shares during the last few weeks. So most of it is really from just the portfolio going up, not from contributions. So
yeah. I am at an all-time high, and sometimes I use Snowball Analytics because it's easier on the phone, but they do have a nice chart where you can benchmark and you can see a dip, and it just comes straight. It's nearly like the Nike sign. It just goes straight back up.
While at the same time we lost almost 10% on our euros compared to the dollars, right? Because of the currency exchange rate that changed so much. Yeah, interesting. So, hey, if you talk about the German, then let me take the next German. It's Allianz, because next week we will have some Dutch probably, and then Group and ASR and such.
Yes.
I mean, Allianz also clockwork. It's unbelievable what these companies are doing now. I mean, there's so much money to be made in insurance, right? It's we must be ripped off. And actually, yes, my car insurance has increased a lot over the last few years, and probably Allianz is benefiting from that as well. But they increased the entire, what they call top line business volume, by 11.7% year over year, from 48.4 billion to 54 billion, which is a lot, I would say. Bottom line, they increased by 5%, and then therefore their EPS grew from 6.42 to 6.61%. They're talking about that the net income is a little bit less than the growth of the total business volume due to restructuring costs, tax provision, If you look at the operating profit, the 6.3% up, but one of the most important metrics for me is the Solvency II ratio, which stands at 208. It was 209%. For people that don't know what the solvency ratio means, is effectively, let's call it a balance sheet measure that tells you how well covered they are. To be able to, how is it? To be able to, what's the English word? To meet all obligations.
Yes, meet all
like
obligations.
Yeah. So, and they typically wanted to be above 150%, because that gives a good margin of safety. Under 150%, typically dividend comes at risk. And so they're paying out the dividend, let's call it like that, and they're having a similar solvency ratio, which is therefore really good for this company. Other than that, they just continue to create a lot of capital. I mean, this company is just effectively well managed. A few years ago, when I bought them, quite some shares, was when they had this issue in North America with this teachers fund, where there was some, I don't know if it was fraud, but there was definitely some wrongdoing. They had 800 million, I believe, in fines. They paid it off, and I mean, like, as if it never happened in their asset management division. I mean, it was like keep the change. That was kind of it, right, at the time. So I'm quite, I'm just quite impressed. Good results, Derek. Very good results and good start. Property casualty business just continues to really do well. It's the largest business, 27 billion in volume, but the life health. So if you're interested in a competitor, potentially European competitor of UnitedHealth, 25 billion, and they grew 17.6%. It's just less profitable than the property casualty business. So solid earnings. Happy shareholder here. And I just mentioned about the total return. The share price return. No, Siemens is beating Allianz, and Allianz have got the 82% growth.
I think quite solid earnings overall from Allianz. Total business volume grown 11%. I think that's pretty strong for an insurance company, I would say.
Yeah, exactly.
Nice. Now we have quite a few listeners' questions. We might jump straight into them. And Dividend Controller has asked, if you had to start your dividend growth investing journey all over again with the knowledge you have right now, what would you have done differently?
Focus on dividend safety more.
I would have just bought all insurance stocks in Europe.
Yeah, that's true. I would have probably done the same.
I would have took out a new mortgage. I would have bought Shell during COVID and bought all the insurance stocks. And I'd be sitting here now with my 100% retired badge saying, look at all you suckers, which are slow compounding. Yeah, no, I agree. I think dividend safety, but also conviction. I think understanding what you own and knowing what you own, I think is really important, because we bounce companies off each other the whole time, and we don't exactly have the same companies. But I think it's very important that you know what you own and why you own it, particularly.
And not buy it because people on social media own it or say they buy it. It's good for inspiration, because some of them, they do really well in the stock market. But at least buy a book, learn about the 3 financial statements, take the course and really get into this, because stock picking, it is important that you protect yourself, and what you mostly need to protect yourself from is your own stupidity.
Yeah. I mean, I think everybody should have a record, maybe one sentence of why they own each company.
Yes, exactly.
And it shouldn't say because dividend yield is good or something like that. It should be something tangible with the business.
That's why I sold Viatris, because literally I written in my notebook Viatris for the biosimilars and the Viagra.
And they sold it.
And they sold the biosimilars.
Yeah.
So and now I was already for 1 year lost. What is this business doing now?
Yeah. Makes sense. Can't borrow conviction. We always say it. You cannot borrow conviction.
Exactly.
PJ has asked us, with the 13F filings coming out, do you use them for idea generation? And if so, are there any interesting ideas you found from the most recent batch?
No, I don't use it at all. Not at all.
Should not follow Bill Gates. Did you see? I only seen that one today. Someone must. I don't know.
No, I see my whole timeline with it, but I don't do anything with it because it comes with usually 45 days delay.
Yeah.
So it's already old news. Secondly, how many dividend growth investors are there?
Everybody's a dividend growth investor in the end.
Yeah, okay, but you know what I mean. It needs to also fit in your portfolio. So no, I don't use it for inspiration because I hardly ever get inspiration out of it. I think, after I'm now investing for a decade, Derek. You know where I get the most inspiration from people suggesting stocks on the podcast here that I've never heard of. That's where I get inspiration from. Because for the rest, I've got like a list of 200 to 300 stocks that I know of that I could own maybe one time. Yeah. So that's why that's why I don't use screeners anymore so much. That's why I'm not so interested in 13Fs either. I know kind of what my stock bubble is.
Yeah. 2 interesting companies is Sampo and Mandatum. I know we've got.
That will be much more interesting for me now.
Yeah, definitely. Stefan has asked us about Unilever. So as they will spin off the Magnum ice cream company at the end of this year, is there a general approach of how you deal with spin-offs?
Most of the times I sell them.
Yeah.
Unless I think it's a very high quality, like ABBV spun off from Abbott. If you think about that, was really good to own it. Although ABBV was also loaded with debt, and that's what you typically see, right? They offload a lot of debt in those companies. But with Magnum, I will probably sell it because I disagree with the size of the Magnum ice cream.
You can't borrow conviction, and that is conviction.
I think it's overpriced and it's just getting shorter and shorter and shorter. So smaller and smaller and smaller. So I mean, how small can it get?
I mean, go down to Lidl or Aldi and you get their version of
the big ones. Exactly. So no.
There you have it. We're selling Magnum Ice Cream Company because their ice creams are too small. Icrive. Can European DJ elaborate about why he likes Chesnara? Is this an income factory inspired choice?
Yes, it was an income factory inspired choice when I didn't know yet about the income factory, because I have it now 5 years in my portfolio or 4 years in my portfolio. I always liked it because when I was doing all the research about the Noble 30 index, I discovered Chesnara. It had at the time, I think, a 22-year consecutive dividend growth and nearly 9 to 10% yield. And when I looked into it, I found the dividend actually quite covered. I understood the business. It's a hard business to understand, but I understood what it was doing. I can read their material. I have a little bit of accounting knowledge by education. And I thought like, yeah, I remember we were one time talking about Chesnara because at the time they had the most boring CEO that you could imagine. Like if he was talking, you would almost fall asleep. He wear only gray suits, dark gray and light gray. He was gray. I mean, everything fitted with the business. I thought it was a perfect match. So yeah, that's why I like it. But I think Chesnara will be for most people on the too hard pile. What they effectively have is they buy open-ended funds and closed funds, and you need to think here about pension funds. So and they buy it from other insurers. So if an insurance company was providing pensions to companies or something like that, but then they closed it, but they still have, let's say, a certain amount of people in there with an obligation for the next 10, 15 years or until all those people are dead, then Chesnara buys that. Yeah, and they margin on it, and from that margin they can pay the dividend. That's in the UK mostly because Chesnara was a spin-off from a UK company, and I believe because of that spin-off they were not allowed to also go themselves on the market, but that's what they started doing in the Netherlands as such. So they have a few open-ended funds as well, and therefore their core business is effectively acquiring such I guess pension fund obligations at a good margin, and they've been doing it quite okay. It's a small position to always be a small position, but it's a high yielder. Yeah.
Sergey has asked about any chance of interviewing Joseph Carlson. He knows that you post on his Twitter from time to time.
I think we should ask him.
Yeah, why not? We've nothing to lose. Let's try it.
Exactly.
That's right. Peter has asked us to use AI to support any analysis. So, for example, ChatGPT tells him that the core of European DJI's investment strategy revolves around dividend growth, prioritizing companies with a history of increasing dividends, financial stability, which means selecting firms with strong balance sheets and consistent earnings, and long-term holdings, emphasizing a buy and hold approach to benefit from compounding returns. AI knows you pretty well.
Yeah, I know. So I don't use AI for analysis, but I use AI to support. So for instance, sometimes I upload annual reports in Notebook.LM, and then I ask it questions, and then it tells me exactly where you can find it on what page, and with the quotes and everything. And that helps a lot. That really speeds up my work. If you upload, let's say, 10 annual reports, you can also find patterns via Notebook.LM. I find that very powerful, and it just saves me time and analysis, because sometimes you know what you're looking for, and Control F is not enough in an annual report. So using Notebook.LM for this is really good. But what I don't do, I don't use it for computations and valuations, because I just see that it makes a lot of mistakes. They are not always so good in counting. I mean, come on, guys. The brokers can't give us even proper dividend data for European companies. Do we expect them to have the right data in there? No. So if I anyway need to do it, so then I do it myself. And also I create my own data. So if people read the deep dives that I'm doing, I'm looking at segments analysis and everything, and you really need to usually data scrape that from all the reports. And I haven't seen that in the AI yet. I played with it to see how good it is, and I do believe maybe in the future you can train a model, but the data input needs to be better, and the data input is typically still too poor, not actual, which makes it hard. Now, what I do use it for a lot is, like, I'm not a native English speaker, so I'm writing. Sometimes there's one prompt that I use is fix English. I use that a lot. so that the commas, the spelling, and all is correct. But I don't use, for instance, the prompt improve English, because what I notice, if you say improve English, it feels like a weirdo, the text then. Like, it's not me. If I do fix English, yeah, that's me. Yeah. And I think it's really important, just in daily life, not only for what we do with the content, is to stay authentic. Yeah, that's really important. There are just certain words I would never use, and that's why, yeah. So I don't really use it, but sometimes for what I mentioned, like to speed up my analysis process as such.
Yeah.
But NotebookLM is for me the favorite tool for that, because it's focused on the researcher.
Oh, very good. I've never used NotebookLM, so I might try it out. Yeah, I played around with it before. There was a Facebook chat around that, and it all depends on the prompts and what you're looking to get from it.
Yeah.
If you know a company quite well, you can upload a report and you know a couple of things to look for, and it will spit it out. But if I'm looking at a brand new company, I prefer to go through the process myself, because it'll force me to think and learn and know about the company. Otherwise, I'm just being
and that's the risk, right? The studying part of a company is equally important. So, and this comes really back to know what you own, and you can't borrow conviction. Also, the AI can maybe give you all the nice flashy reports, but if you have not gone like an Inspector Gadget through a report, through the notes, to follow the money, let's say via the income statements and everything, why there is a certain because that's what you see, right? If you look at the balance sheet, you can see patterns. You see like, why is the long-term debt suddenly 5 billion less? Oh, wait, it moved to the short-term debt space because debt is expiring. Let's go to the free cash flow statement. They've been reissuing a lot of debt as well at the same time. Yeah. And there. So, I mean, I've tried that, but I can't get that out of the AI at all.
I suppose you probably could get it, but you have to ask specifically for it.
Yeah, but I can see it in 3 seconds.
Exactly. You'd see that, but I mean, if you're just asking AI to analyze this balance sheet, it's not going to do any of that for you. It's not going to.
Yeah, and otherwise you need to give 100 prompts, because there are 100 prompts that, with all that I internalized over the last decade, that I can quickly see.
Yeah.
So I have a shareholder equity. Why is it in the minus? Oh, the returned earnings are in the plus, but the share buybacks pull it in the negative. Yeah. Okay. So what does that mean? Yeah. How much debt is there? What is the assets? What's the goodwill? There's I think I don't. No, let's say like that. The AI in my brains are trained enough that I can do that really quickly. So I don't really see an optimization there.
Yet.
I'm very impressed with AI. It will make many stuff obsolete, definitely. But with that, we can even become better in everything we do. So I'm quite positive about it.
Yeah. Hans has asked us if we ever consider preferred stocks, and he's talking specifically like a company like IIPR. He feels like there's a dividend cut coming soon. They're very high, they have a very high yield. However, their preferred stock pays out about 9%, and they get paid out before common stockholders.
Yeah. I never bought it. I know there are a few people that are a fan of it, more also from the income factory philosophy, but I never really considered it. I understand that you have a first right as a preferred stock. What I've often seen is that the share price is kind of dead money for these kinds of things. So never really interested me. And so his follow-up question therefore also, are preferreds redeemable at same price as issued? I would need to look it up in the books in my bookshelf here, because I'm sure it's written in one of those books that I have. I've got those like 1,000-page books about financial accounting, financial reporting, and everything. So I will probably find it there. But
yeah, I've seen those books, and it might take you a while to find that. Good luck with that. Hussein has asked us, what is a more reliable metric for you? PE, price to earnings, or price to free cash flow?
So if I really need to give a simple answer, price to free cash flow is, I think, harder to manipulate than price to earnings, but can still be manipulated.
Of course. Yeah, but free cash flow essentially what my dividends will be paid out on. So
Yeah.
that's what I pay more attention to.
Yeah, but he asked here about the reliability of the metric, right? And for instance, you can do a lot with inventory management. I think we will see a very weird cash flow statements in Q2 because of the tariffs, whereby people bringing inventory forward before the deadline, all this kinds of stuff. So it is not necessarily reliable, but I think what he's asking is what is more reliable. And then over time, I've seen the free cash flow is more reliable.
Yeah, but I think even in that case, sometimes with earnings, they can hide numbers easier. At least with free cash flow, I know they can move stuff around with inventory and working capital, but you can spot it a little bit easier.
Yeah. Yeah. Although I would say the free cash flow statement is a bit harder to read. Specifically, the concept of working capital is for many people not easy.
Yeah.
So there's something there, but with price to earnings, it depends also what earnings the multiple is based on, because many times the price earnings is calculated on management's version of the earnings. So not the GAAP earnings, but many times I see that they took the earnings from the adjusted earnings by management.
Yeah. So
then you're just being fooled around. So that's also a reason why price to free cash flow is a nicer multiple for me.
Yeah. Anders has asked a question about your spreadsheet, and he's just asking, how does the split function work? For a bit of clarification.
It doesn't work. I think it's broken. I ended up kind of making a fake buy sell in there, or sell buy. So if it goes, let's say I had with Apple, I think it went 1-on-4. So let's assume it was 25. Then I said, okay, sell 25 at this and then buy 100 at that, and it was fixed. You then have a little bit maybe issue with the history or something like that, or for the average price. Yeah, but it's the one only function I think that doesn't function.
I'm sure someone in this community will know how to get that.
Yeah, it worked around it, like as I just mentioned. Yeah, you take the average price and then you're good, I think.
Mayak has two questions, and the first one is in relation to Starbucks. What do you feel about the possibility of them selling its business in China?
To whom?
I don't know.
I don't know who wants to buy it or who can buy it.
Who's that Chinese competitor we spoke about before?
LGEN brand.
Yeah, maybe they might buy it. I don't know.
Yeah, but the stores look totally different from what I've seen and heard. I think I wouldn't probably do it. First of all, they won't get a good price for it. I can't imagine. Secondly, I do believe there's a lot of space for Starbucks there. If they fix the American issue with pricing and product perception related to pricing, then they may have a chance also quickly recover in China, I think.
Yeah. But maybe all this China, US tariff wars, price wars, maybe they just want to get out. Who knows?
Maybe.
Who knows? The second part of this question is in relation to Euronext and their earnings. I didn't check their earnings. But do you think that it's possible that the EU would strengthen its capital markets, which would be a huge tailwind for this stock?
Well, yeah, possibilities always.
Yeah.
I do understand the sentiment, because Europe is now much more on the investment curve. At least that was what we were hearing before the tariffs, right? Due to the trigger of America kind of pulling their hands out of Europe, let's say, in terms of support, but also the realization that from innovation-wise, we're not doing anything really in Europe. So I do think there's a more positive vibe at the moment in Europe that Euronext could benefit from.
Yeah. This company keeps coming up, actually, Euronext. So it's one we have to look at.
Also, Mikey brought up that around Euronext that we should look at the salary and the compensation for the board of directors, because I believe the shareholders have rejected the proposal. So that's interesting. You don't hear that too often, right? That it happens at a company.
Yeah.
So it seems to be that management is more rewarding itself there than the shareholders. So he advised us to look into this.
Yeah, very good. Very nice. Rob has a question, and it's about insurance companies. The stock prices can be so different. So if you take Munich RE, for example, it's trading at around €570. Wow. But Legal in general is trading at only £2.40. yet both seem good with inverted commas. So both are good stocks with long dividend histories and stable income. So what's with the huge price difference? And does the price even tell us anything about the stock itself? And would you say, would it sway your buying decisions if you were a beginner investor?
No, the share price. The share price you need to see related to the earnings or the free cash flow. That's really what you need to look at. There can have been stock splits over the years, and other companies may not have done a stock split. Yeah, so you really need to understand why. What I can say is that Munich Re has been compounding, because I bought it at around 160 and it's 570 now, as to his point. But at the same time, Munich Re always had a much lower yield. So much more of the money left could be reinvested in the business, while all the money of Legal & General goes to the dividends, almost all. Yeah, and not so much can be, as with Munich Re, be reinvested in the business. Munich Re is also a reinsurer. With how global tensions are going, many more companies like reinsuring maybe than they used to do before.
Yeah.
Legal & General has a lot of exposure to the UK, and we know what happened there with Brexit. So those are also all kinds of different reasons why share prices develop differently. Then there's the share, how many shares outstanding are there? What's the market cap? You need to take this all on the mix. So I don't look at it from that point of view.
Yeah, but if you're a beginner investor with limited buying power, and you have two companies, and let's say limited buying power, you have 250 euro, and you've got Munich Re trading at 570, and you've got Legal & General.
But then you can't buy Munich Re if you can't do fractional shares.
Yeah. So it's gonna sway your decision. Like
but it's not even decision.
Yeah.
Unless you have 575 euro, and you can, and then the commission of the it's not more than 5 euro.
Yeah. But I still think it would sway your decision if you had 1,000 euro and you could buy you can still only buy one share. So you only can buy one share of Munich Re, or you can buy many more.
I've been doing that also the whole journey, right? If I can buy shares for 1,000 or 1,500 euro, and you want to buy LVMH, you buy 3 shares. But if you buy something else, Unilever, you buy 30 shares.
Yeah.
It's always been the case.
But as a beginner, when you were starting, I don't think you would have thought like that. Well, maybe you did, but
no, I did.
Yeah.
I don't care what, as long as I can buy it for that 1,000 euro, let's say, because that was the money I started investing with. I don't care if it's 5 shares or 100 shares.
Yeah.
I care about the dividend. If I know that on the 1,000 euro I get, let's say 30 euro of income or 50 euro of income, all else being equal in the quality of the stocks, I go for the 50 euro of income.
Yeah. No, I'd agree with you. I just think as a beginner, I would have been swayed definitely by that.
I didn't. I never experienced that, but I fully understand Rob's question. And it's a very good question. And I'm also happy that he asks it. And I hope that this answer also helps him.
Yes, I'm sure it will. I'm sure it will.
Because the share price should represent the earnings power underneath. That's why you look at multiples like price to earnings 12 or not. Because I don't know what Munich Re is making now, 570, but maybe it's making 40 euros. On a yearly basis, then you get for 13 PE. Legal & General 2.40. Maybe it's only making, I don't know, £1. Yeah, then it's a 24 PE. Which one do you want to own? All else being equal, I would go for Munich Re then.
Yeah, I agree with you. Again, you're taking all things being equal. We're not equal in this scenario because we're talking about two different yields, dividend yields. One which I would imagine is lower than the other. So it's not really being equal. But if it was being equal, it's the share price is irrelevant. So I just think as a beginner, I would have been swayed, but I don't think it is.
But this is the reason why I think many people go to penny stocks and everything.
Exactly. So I agree with you on this. I do agree. I just think as a beginner, the way your mind works, it's probably more to the share price. I can buy more of this company, own more of this company, which is I understand what he said, but I never had that, Derek. Really never. Yeah. So it's not something I can resonate with. I have always focused on the on what do I how much earnings power do I get out of my money. Yeah, I can see the confusion on your face, but and for the record, I do agree with you. Micah has asked us if we could have a look at his previous question on a company called KARO, KARO. And I briefly looked at this company just before we went on air, and KARO Limited, and that's like KARO. It's got about 4 or 5 O's at the end of its name. So they primarily make money through like this SaaS business, and its flagship platform, as you'd say, is in this like real-time mobility and data analytics and vehicle tracking services. That accounts for more than 80% of its overall revenue, and SaaS revenue is around 98%. It makes most of its money in South Africa, but it's trying to expand into Southeast Asia and then also some in Europe. And I looked at it, it only has 3 years of dividend history. So I'm looking at that already going, it's not quite enough for me in terms of this business. It's also making most of its money in South Africa, which is an area I don't know particularly well. Africa is kind of alien to me in terms of how stable it is for this type of business. Even in Europe, I don't know if I'd like to own this type of company. Then I looked at its earnings, the PE ratio. It's trading at 27 times earnings, which is also too rich for me. So yeah, there wasn't enough in this company for my initial screeners to want me to actually look a little bit more into it. When I see these types of like software as a service, and it's like vehicle tracking services, I always feel like it can be easy to replicate something like that in my mind. So yeah, it just didn't grab my attention, if I'm honest with you. Not enough dividend history, too rich in value, and a business model that I'm not 100% keen on. So yeah, not for me. Not for me.
I see.
And actually, the first thing I thought of is if they have to put 5 O's at the end of their name, I'm like, they're taking the piss here. I can't take them serious.
Yeah, that makes sense.
So sorry, Micah, but not for me. Ketu has asked us a question on our Discord channel. What private companies would you love to be public dividend payers?
Yeah, he mentioned Chiquita Bananas, right?
Chiquita Bananas.
Obviously, Lego, IKEA. Those would be 2 that come straight away to mind. And there was the other day, there was another one. It was a healthcare company. Ingelheim or something like that.
Stripe always comes to my mind, which was one because it's Irish based.
Yeah, you like it?
Yeah. So, but IKEA, I think, and Lego. I pick Lego, definitely Lego.
In Europe, there are many iconic businesses that are still family owned or private equity owned, right? Which is somewhat a shame.
Yeah. But you can get access to them with some investment trusts if you look deep enough. There's definitely ways into investing in them. But yeah, I think Lego I would just buy as a token, no matter what.
Yeah.
Even if the fundamentals were shit, I would still buy them just to have 1 or 2 shares.
I would also like to own the Dutch pension system because they generate yields that are so low, and I think there's so much easy money to be made there.
Yeah. Nice. Well, that was the last question. Thanks so much to all our listeners as usual. If you've listened this long, thank you very much. Enjoy your walk, enjoy your coffee if you're having coffee, although we've heard nobody really drinks coffee listening to us. But we would really appreciate if you like, comment on any platform you listen to, because it will really help us. And we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just 2 guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anyone else. We always recommend that you do your due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to my podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.